Welcome, everyone. We're going to get started here just in about 1 minute, right at the top of the hour. All right. Welcome, everyone who's joined. I'm Chelsea Treseder, and I am joined by Kate Zerker from the MVP team, as well as my brother, Will Dials. And we, along with our other brother, are the founders of My Vitals Pro. And I want to thank everyone so much for being here today. Okay, we have a lot to cover. This is going to be a very meaty presentation. So here's a quick roadmap of how it's going to go. I'm going to start us off by explaining who we are and why we have this incredible amount of data that we're going to share today that enables us to empower independent hearing care practices with real-time insights. We did another webinar like this back in February that I know many of you attended. And so Will is going to share some updated data, what's happened across the data set since then, kind of what's changed and what hasn't. We're then going to spend a bunch of time diving into the Medicare and Medicare Advantage enrollment data for 2025 and some interesting insights that we've uncovered there, along with some broader news on the Medicare Advantage front. Next, we'll take a look at what impact the developments in the TPA segment of the market have had and are having on hearing care practices. And finally, we'll do some forecasting on what lies ahead and what independent practices can be doing to set themselves up for success. We're also planning to leave time for questions at the end. I'm not exactly sure how much time we'll have for that, but we're happy to stay on as long as needed to answer as many of those questions as we can. So I do see many familiar names here and lots of existing MVP users. Great to see you all. But for everyone else, I want to take just a minute to explain what MVP is and how it's made today possible. So MVP is the hearing care industry's business intelligence platform. Business intelligence is the discipline of taking enormous amounts of data, enriching and transforming the data, and then using that data to provide actionable insights to stakeholders in a business. By integrating directly with your office management system, MVP eliminates any manual work for you and your team and shows you exactly what's happening in your business and why, with dozens of critical KPIs calculated for you at the clinic, provider, and company level across any time period you'd like. MVP features nightly automatic updates, forecasting, detailed and powerful data mining, goal setting and tracking, benchmarking to like-size practices, market share, penetration rate, automated emails and data alerts, and language-based data interpretation. So with that robust set of features that I just listed, the primary purpose of MVP is for any individual practice to be able to better understand their own business in real time. But because we have over 1,100 clinics in the MVP dataset, we're also able to look beyond any one individual practice and can pull out trends that are happening across the independent channel of the hearing care industry. And I want to pause for just a second to explain why we're hosting this event today. And I think the best way to do that is to share with you all a couple of our guiding principles here at MVP. One of them is data equality. We want to give small, medium, and large private practices access to world-class business intelligence tools that are more robust than even their, bigger, more well-funded competitors, so you can fight above your weight class. We automate every managerial task we can to enable practice managers and owners to focus on taking action rather than trying to figure out what's going on. And finally, we are obsessed with private practice. It's our mission to empower private practice owners by arming them with insights to better manage their businesses, because we know that patients are best served in the private practice channel. So with that, I want to introduce Will for our first section.
Awesome. Thanks, Chelsea. Let me get my screen share up here. Thanks, everybody, for being here. All right. Perfect. Sorry, 1 second here. I'm going to try that again. All right. I'm having a little issue with my PowerPoint. Give me 1 second, and I'm going to fix that here. Okay. Bear with me. Off to a slow start here. Okay.
It's okay. We'll make up for it when I talk fast later.
All right. Okay, start my slideshow. All right, now this should look better. Okay. All right. How's that?
Looks great. Yeah.
Awesome. All right. Great. So I'm going to go through a quick update here of what we've seen in the MVP data set, kind of what we saw early on in the year that kind of gave us a reason to do the first webinar back in February. And we're going to look at see what's changed since then and what we can learn about that. So if we go through here, this is kind of the most important or the most eye-opening piece of data that we uncovered. And it was basically a multi-quarter downward trend in the number of new patients coming in to private practices within the MVP data set, going back to the first, really the high watermark being the first quarter of last year, with now 5 consecutive quarters of declining new patient appointments per business day, including this second quarter of 2025. And when we layer in the demographics, which is just the number of people that are over the age of 65, the people that would in theory be great candidates for hearing care, we are, it makes it all the more concerning that trend would be going down while the demographics are going up. We should be seeing more patients, not less. And here's a quick slide from that we showed back in February, where we just kind of called out some high level KPIs and showed year over year differences in them at this point in time. So new patient appointments were way down. Total private pay units were about flat, with third party units being down almost 20%. And down in the bottom row, if you look down, you could see that the new patient units were down significantly while existing patient units were up. Now, quick definition there. In MVP, we categorize everything, all hearing aid units, private pay only, as either new or existing based on whether it was in the first 6 months of their first appointment. So if any sale that happens within that first 6 months would be a new patient unit. Anything beyond 6 months would be an existing patient unit. So big drop in new patient units, big drop in TPA, not surprising at all, given that the new patient appointments themselves were down. But all the growth that we saw at that early point in the year was coming from existing patients. If we look at that now, so through the 5th of May, just through the end of day Monday, new patient appointments are still down considerably, not quite as down, but still down. TPA units are down again, a little bit less down, but significantly. Overall, private pay units are now showing slight positive year-over-year growth. So that's great. I don't think anybody's extremely excited about 3% growth in that particular category, but that is better than it was. And the private pay unit growth, again, is being entirely driven by existing patient unit sales. Now that's up 17% year over year, with new patient units down about 5%. So basically cut the loss, the drop in half, essentially. It was down about 10 in February, now it's down 5. So that shows signs of recovery there. Okay, so we looked at data similar to this back in February, but I've updated it and kind of displayed it a little bit differently. Here we're looking at that same chart you saw earlier with the new patients per day over time. So you can see that drop starting in the first quarter of last year. And we're just overlaying some other sales metrics alongside of it to see if there's any correlations or anything that we can spot. And what we see here is the total number of private pay units going back to 2022. And you can see we basically hit the high water mark in the fourth quarter of 2024 with a big drop in Q1 of 2025, this first quarter of this year. And that's really what when we were meeting last time, we were really feeling that. And I think a lot of practices were feeling that. And that's why it kind of made sense to do it at that time. Thankfully, we've seen a nice bounce back in the second quarter. We're not quite to that Q4 level of volume, but we're definitely on our way, and significant improvement from the first quarter. So that's nice to see. If we isolate new patient units, again, those units sold within the first 6 months of a patient's first appointment at the clinic. Okay, those units are also bouncing back in the second quarter, not nearly as much as the total, but they are certainly better than they were in Q1. But still, as you can see, a little bit lower than they have been over recent quarters, is going back to last year and even a little bit in 2023. So still a little bit of sluggishness in that new patient private pay unit business. Existing patient units tell a different story. It's just been really nothing but climbing up into the right here, this entire chart, with this second quarter being an all-time high. So the existing patient unit sales, you can't even say it's business as usual. It is as good as it's ever been in that particular category. And that's what we're seeing that's driving a lot of the success that some practices are having this year. Now, if we identify third-party units, different story. So third-party units took a huge dive in Q1, along, similar to some of the other metrics we were just looking at. However, there's no recovery that we're able to observe here occurring. In fact, Q2 is looking a little bit worse than Q1. So that is interesting and something that we want to spend some time kind of digging into, which we will in the next section, where we get into the CMS enrollment data, because it's very related to that. So another way to look at these trends, if we similar, but just a different way to look at it, is to break things down by week. So what you're looking at here is looking at private pay units per business day by week, going back to 2021. And we've got a little bit some color conditional formatting on these columns here. If each week is measured against the trailing 12-month period before it. So if a week is outperforming its trailing 12-month baseline, it would be green. If it's slightly below, between 0 and -5%, it would be gray. And if it's below -5%, it would be red. So that's what the colors tell us here. And when we look at private pay units, what's interesting is you can see we've identified the first day of every year just to kind of pick up on any seasonal patterns. And it does generally look like the end of the year, that last week in particular, is very slow. A lot of people don't work that week. And a little bit of a drop off at the beginning of each year, followed by a recovery to some degree of normalcy. Now, the beginning of 2025 looks pretty rough, and I think a lot of people were feeling that, and that's one of the reasons why we did that webinar back in February. Thankfully, you can see that the columns have returned to historical levels, and you're not seeing nearly as much red as we were at the beginning of the year. So that's just an interesting observation. It suggests that the private pay unit business is stabilizing and returning to some degree of kind of historical normalcy. TPA units tell a different story. So, and this also shows that same big drop at the beginning of every year, with the exception of 2023, which is interesting because this is the kind of thing that could theoretically be, people could be persuaded to use their benefit at the end of a year or at the beginning of the year, depending on whether or not the benefits were getting richer or getting more restrictive. So there's some variables in there that might change the otherwise normal behavior of patients. But this year, you could see that it's pretty much all red and significantly lower levels than we've seen in really the past 2 years. So I believe it's 13 consecutive weeks, if I counted those bars right, of below the trailing 12-month average level of performance. So no signs of recovery there. Another interesting thing that we wanted to kind of talk about, we introduced this in the our year in review document that we put together at the end of last year, where we identified a group of clinics within the data set that represents the 85th percentile in terms of revenue per hour. So those are our MVPs within the MVP data set. And the whole idea was to be able to identify practices that are performing well and to see what, if anything, we can learn from their KPIs, from their numbers, to see what's driving success in private practices. So if we look at these two groups of practices, so the MVPs and then everybody else in the data set, we can see that the new patient appointment decline is roughly the same. So that suggests that these practices are not immune to whatever macro conditions are out there that are presenting challenges in practices. They're feeling it too. If we go to the very bottom of this chart, you can see they're also feeling it in the third-party units. They're down even more in the third-party side of the business than the rest of the data set. However, what we know about the MVPs, and this was in the year in review, that they're far less reliant upon third parties as a percentage of their total hearing aid units. So even though they're down, it's not having the kind of impact that it would have if your business was more reliant on that particular channel. But the thing that stands out, I think, probably more than anything, is the fact that the existing patient unit sales here at 38% year-over-year growth that's the clear differentiator. These practices are doing extremely well by selling hearing aids to their existing users. Probably not a huge surprise, but it's certainly obvious when we look at the data in this format. Okay, and just to kind of summarize this first section here, new patient appointments have been declining for now 5 consecutive quarters. Which is unprecedented and ahistorical, at least in our data set. And given the demographics that we're seeing, the growth, even stagnant figures would be concerning. So we would expect more patients, not less, coming into practices, and at least for the last several quarters, we're not seeing it. The TPA business is significantly below historical levels, and really there's no sign of that changing. Nothing we can see in the data to indicate any recovery there. Private pay units in general have pretty much rebounded and stabilized. Again, not 3% growth, probably not what anybody's looking for. So we can't really take a victory lap yet, but it does appear to be stabilized and rebounding. New patient unit sales are still a little bit sluggish. And if for those of you that attended our webinar back in February, there were a number of highly plausible theories that were put out there, from macroeconomic concerns, political instability, a really bad flu season, inflation, Google Gemini, AI summaries. Those are all plausible theories for what could be explaining the slowness or the disruption in that segment of the business. However, the fact that it does appear to be rebounding and bouncing back suggests that that was probably more transient and not something that's going to present challenges going forward. But all the growth we can see, for the most part, is coming from existing patient unit sales. So yeah, that is the end of the first section here. So I believe it's time for Chelsea to come back in here.
Yeah, great. If you can stop sharing, I'll share my slides. Perfect. Okay. All right. Give me just a sec. Okay. Can you guys see my slides okay? Looks great.
Good.
Okay, great. Okay, thanks for the update on the industry-wide data, Will. So what we're going to do now is transition to section 2, where we're going to be diving a lot deeper into what's happening with Medicare Advantage, primarily because the TPA numbers have been and continue to be so soft this year. So we really felt that this warranted a much deeper investigation and analysis. And in this next slide, I'm going to just do a very brief backgrounder on why we are talking about Medicare Advantage. And that's because what happens with Medicare Advantage, enrollment numbers, what's happening with individual plans is very explanatory of what's happening on the streets in our clinics. Medicare Advantage plans have become the largest source of hearing aid benefits in the US, and actually 97% of Medicare Advantage plans offer some sort of hearing benefit. So this becomes a very, significant influence on our industry. So I wanted to explain kind of how Medicare Advantage relates to TPAs and our practices. So the first point is that, traditional Medicare, as we all know, does not cover hearing aids, but Medicare Advantage plans frequently do. It may be through narrow networks and limited benefits, but this does become a key marketing feature of Medicare Advantage plans as they compete with one another for new enrollees. Will's going to be going into this in more detail in a moment, but Medicare Advantage enrollment has grown rapidly. It's now over 50% of all Medicare beneficiaries. And these plans do advertise hearing benefits to attract new members, despite that coverage potentially being fairly limited. Medicare Advantage plans do not administer hearing aid benefits themselves. Instead, they contract with these third-party administrator companies. So these are True Hearing, Amplifone, et cetera, to provide access to a network of providers, negotiated discounts on hearing aids, and centralized benefit management, claims processing, customer support, et cetera, which in short allows them to offer hearing aid coverage without having to build really any expertise in-house. The other thing that's just been true historically is that, over the past several years, we've seen a very tight correlation between the rise in TPA hearing aid unit volumes and the increase in managed care plan enrollment. So as Medicare Advantage grows, so does the footprint of TPAs in hearing care. Okay, and then the next one is just to kind of understand how the incentives for plans and TPAs really align. So Medicare Advantage plans, their goal is to offer attractive benefits at a low cost. TPAs, they want to grow their network and move a high volume of hearing aids. Manufacturers, they want to gain market share by distributing their devices through as many channels as possible. But obviously, the potential downsides come when you look at private practices who often face, lower reimbursements or margins, sometimes less control over the patient process. And then, of course, there's the impacts on the patient, which we're going to get into in section 3. Okay, so the next thing I just want to talk about, I want to step back from audiology or hearing aids or anything directly related to our industry and talk about some of the challenges that Medicare Advantage is facing overall. If you've picked up a newspaper or turned on the news anytime in the last few months, you may have heard some rumbling about this, but there's definitely a lot of challenges for the companies that play in this space. So one is, and again, we're going to talk about this in more detail in just a second, but These plans are exiting unprofitable counties. So Humana exited 13 underperforming markets, had close to 500,000 intentional membership decline as a result, and is kind of reflective of some broader trends we're seeing with insurers strategically withdrawing from less profitable regions, counties, markets, what have you, to try to help stabilize their own financial performance. Another one is just the kind of unexpected surge in care utilization among Medicare Advantage enrollees that's been coming still out of the pandemic. I know in some ways it feels like COVID was a long time ago, but these companies are still experiencing people, looking for that care that they delayed or put off during COVID, and that's leading to higher than expected medical costs for these insurers. Another is just simply kind of the fact that the population is kind of older and sicker than people may have predicted. So that leads to higher healthcare utilization and impacts insurers' profitability. These elevated medical costs, of course, as you might imagine, like make it hard to sustain these plans and deliver the profits that these companies have projected. Another one is kind of so even more broad than just Medicare Advantage are profitability issues in the entire health insurance market. So not specific to Medicare Advantage, but when you look at health insurers' profit margins, they've declined from 5.3% in 2020 down to 2.7% in 2024. Again, rising medical costs, regulatory scrutiny, inflation, they're all contributing factors. Another one is, and again, we're going to talk about this in a little bit more detail in a minute as well, but the fact that to maintain profitability, many Medicare Advantage plans are reducing the supplemental benefits that they had previously been using to market and attract enrollees. We know for a fact that these cuts are coming from dental, vision, wellness programs, and of course, anecdotally, we hear they're taking place in hearing as well, which might raise some questions about the attractiveness of these plans for enrollees in the future. And the final kind of big picture trend that's occurring are just some of the like legal and regulatory issues that these companies are facing. So I won't go into all the details here, but U.S. Department of Justice filed a lawsuit against major Medicare Advantage insurers related to kickbacks that they're accusing them of paying to health insurance brokers to try to avoid enrolling disabled individuals into plans that are going to be more costly for them. There was a Senate report that's out there criticizing kind of the marketing practices of these Medicare Advantage plans, shows how there are commissions and incentives for brokers that can lead to biased recommendations and potentially misguiding seniors who are looking to them for advice. And also there are accusations of things like upcoding, where insurers inflate diagnoses to receive higher payments. And actually, I think this is interesting. In 2025, the government is projected to spend $84 billion more on Medicare Advantage beneficiaries than if they were enrolled in traditional Medicare. So I think there's a lot of scrutiny on the practices here, which is putting some additional pressure on this industry. So kind of in summary, it's no big secret that there are major challenges in the broader Medicare Advantage marketplace. And I think they put some context around the data that we're going to look at next. So with that, I am going to turn it over to Will, and he can share his screen.
All right. Thanks, Chelsea. Let's see if I can do that a little bit more smoothly this time. All right. Okay, perfect. You guys see that okay?
Looks great.
Yeah.
Awesome. Thanks. Okay, great. Yeah, so normally we get the normally the CMS data, the Medicare enrollment data is available around January 15th of every year. We've been pulling it for years, looking at it. We even have a section in MVP that allows you to go into your own market and see what the penetration, what the individual plan enrollments look like, how that's changed over time in your market, which is important for any practice owner, whether you participate or not in the third-party programs, to understand kind of what the people in your market are coming in, what kind of benefits they may or may not have, just relevant whether you participate or not. So in a way, we were kind of flying blind in February, given that we did not have that data. It was delayed. We didn't get our hands on it till I think it was early March. So it didn't come out as normal. So we didn't have it. So we were in some ways flying blind, but we have it now, and we're going to go do a little deep dive into the enrollment data here. Okay, so there we go. Perfect. All right. So this is a slide that we've used, or the format at least of which we've used in various presentations over the years. Of course, we're updated now through 2025. So what we can see here is the growth in Medicare Advantage. It's the purple bars you see on the top chart, and really the decline in traditional Medicare over the years. Now, having seen this and observed this trend for many years, what caught my eye immediately was the fact that 2025 showed a slightly higher number than 2024 in the traditional Medicare enrollment. That is not something we've seen before. It was very surprising to me, and warranted further investigation, which we're going to get into here. But down below, just to keep things in context, we can see that the Medicare, even though that anomalous thing took place, we're going to look into in a second, Medicare Advantage penetration has continued to increase, albeit at a slower rate. It's still increasing every year. With the still showing roughly 3% growth in overall Medicare Advantage enrollment in 2025. But if we focus on traditional Medicare for a second, we can see that really, not so much back in 2018 and 19 when Medicare Advantage was not nearly as penetrated and saturated as it is now. But really since 2020 and onward, you can see a pretty solid decline in traditional Medicare enrollment growth every year, which can be driven by, obviously deaths of people enrolled in traditional Medicare is one reason for that, but also people switching from traditional Medicare to Medicare Advantage during their open enrollment period every year. So that happens too. So it's a little bit of a mixture of reasons, but what's completely ahistorical is that growth in 2025 that we see in traditional Medicare. So between 2020 and 24, when those declines really started, about 870,000 people every year. The overall enrollment in Medicare declined, but in 2025 we saw this roughly 450,000 increase, which is a net difference of 1.3 million people. So it's a big difference. So if we look at selfishly, when we first saw this, my first instinct was, well, maybe as somebody who has a vested interest in the success of private practice, and historically, traditional Medicare enrollees are better candidates for private pay, private practice setting. Nothing against Medicare Advantage companies per se, but when somebody has traditional Medicare, they're typically more likely to end up in a private practice and in a private pay hearing aid, which is what we believe is in the best interest of the patient at the end of the day. So, however, that does not appear to be the case, that a bunch of people organically decided to change their behavior and consumer preferences and switch en masse to original traditional Medicare. What it comes down to, much more likely, obviously we don't know the individual reasons why people make changes, but what we can see in the plan availability, and the changes over time is largely explanatory of what we're seeing with that growth. So I'm going to introduce just a couple of terms here that we're going to talk about on the next slide or two. But we've got this concept of terminated plans that were non-crosswalked. So what that means is these are Medicare Advantage plans that were discontinued at the end of this calendar year without an approved crosswalk arrangement, which was a plan that CMS approved to automatically transition a member from whatever plan they're in that's being terminated into another one. That happens all the time. So what we're interested in, though, and what's interesting about this year is the terminated plans that were not crosswalked. So just straight canceled. People had to make choices. And we're going to look at the number of enrollees impacted by these terminations. So these are the beneficiaries who were enrolled in the non-crosswalked plan in the prior year that were affected by that plan's termination. And then there's this concept of reversion, which is essentially everybody has to make a choice. If your plan is terminated and not crosswalked, you either have to choose another Medicare Advantage plan, or if you do nothing, you automatically get reverted to original Medicare. Or of course, you could voluntarily choose original Medicare. But if you do nothing, you automatically get reverted and re-enrolled in traditional Medicare. So that could explain some of the Medicare growth that we're seeing. So let's take a look at plan availability over time here. And this is just a total number of Medicare Advantage plans available going back to 2018. And we can see a nice steady climb, lots, more plans available. It's probably big payers coming into markets where they weren't previously operating. And basically have just given more and more patients options, which this more or less tracks with the growth in Medicare Advantage over time. However, in recent years, it's slowed a bit. And in 2025, we're actually seeing, we saw a decrease. I think for the first time that I'm aware of, that I can see in the data, Medicare Advantage patients had less options in 2025 than they did in 2024. So a lot of that comes down to these terminated non-crosswalked plans. And that's what we're looking at here. You can see very few number of plans that were terminated in that fashion in recent years, a little bit of a jump in 2024, and then a huge jump in 2025 with over 600 plans terminated without a crosswalk designation. And that's interesting. But what we really wanted to know was, well, how many enrollees were impacted by this? So that's what we're looking at here on this screen. These are the terminated enrollees. So you're looking at the prior year enrollment for plans that were terminated. So these are the people that were enrolled at the beginning of any given year. By the end of the year, that plan's no longer available. They have to make a choice or get reverted to original traditional Medicare. So what's interesting, the most interesting thing here is the fact that about 2.5 million people were impacted this year, where 2024, 500,000, not a small number, but if you compare that 2.5 million number to some of those earlier years, this is a completely ahistorical, unprecedented amount of lives impacted by this. So it's our position, and I think it's reasonable that disruption to the lives and the healthcare of this many people has to be having an impact on what we're seeing in the data set and in our practices. And I would expect, or I would suspect rather, that other medical industries are seeing similar changes and disruptions just based on the sheer number of people impacted. Okay, so when we look at where these terminations took place, it was not just all over the place, evenly distributed. Certain markets were targeted and based on their profitability. So plans that were not performing well, that were unprofitable, that's where these terminations largely took place. And so this just gives you an idea of by state where these largely took place. And you can see New York at the top. California is obviously a big state. You would expect some of the bigger states, maybe just because of the more people enrolled to show up here. However, we see some states that, like, for example, Ohio and Pennsylvania are fairly large states. They're small. They didn't have much of an impact. So this did definitely impact certain areas more than others. And if we look at which carriers did the more or less of the terminations, it really kind of comes down to three. CVS, which is Aetna, that's the insurance brand they operate under, Humana, and United Healthcare. So they're responsible for the majority of these terminations. So we thought it would be interesting to see what we can learn, because now we've got, these are publicly traded companies and we've got Q1 data out there for them. So we took a look at kind of how they've performed in the first quarter of the year. And what's interesting is that, so Aetna was the number one, according to our data there, was the number one, had more terminations than any other plan, impacted more enrollees. And they actually had strong Q1 results. So their financials looked pretty good. Their stock had a nice, took a nice pop about a week ago, I think it was, when that report came out. And it's reasonable to infer that they likely benefited from financially by offloading those unprofitable plans. Humana also seems to have benefited from terminating those unprofitable plans. They had a good first quarter as well. I don't think it was quite as much of a strong quarter as CVS, but it was still a positive quarter. But United Healthcare actually had kind of the opposite. They had a really bad first quarter report, and the CEO said, basically confirmed that one of the main reasons for that was the high cost associated with absorbing new Medicare Advantage enrollees. And he said that these members came disproportionately from terminated low engagement plans, dragging down performance. So we obviously don't know any of this with certainty, but it's reasonable to infer that a lot of those plans that Aetna and Humana dropped out of, those folks that did find another Medicare Advantage plan hopped onto United Healthcare, which dragged down their financials. Not the only reason for their first quarter poor performance, but it was mentioned by the CEO. And so I think it's reasonable to infer that the dropping of these plans could have produced pretty good results for some of these companies. So it's interesting. It'll be interesting to watch and see what they do come 2026 when they determine where they want to maybe potentially pull out of, changes they want to make. So it's something that we'll definitely be paying close attention to for the rest of the year. Okay, so back to there's just the kind of the variance in traditional Medicare enrollment over time. One thing to note that enrollees whose plans were terminated were granted a little bit extra time to re-enroll in a Medicare Advantage plan. So they were reverted to original Medicare, which under normal circumstances, that would mean you'd need to wait until the following open enrollment period at the end of this year to get back into to switch back to a Medicare Advantage plan. However, they were granted, I think it's called a special enrollment period that went through the 28th of February to switch back to Medicare Advantage if they choose to do so. And so what we did here was we just pulled in the April data to see which would capture any changes that would have taken place by the end of that enrollment period. And what we can see is that if we gained 450,000 in traditional Medicare enrollees at the end of the year, or by January, as of January, with about 400,000 of those reverting back to or switching back to Medicare Advantage in April, presumably using that special enrollment period to do so. So some of the gains were certainly given back, and that is something that we can see here. But if you look at the number of enrollees, I mean, we still have more traditional Medicare enrollees now than we did at this point, in January of last year, which is, if you look at any of the other previous periods of time, that's just not been the case. So the traditional Medicare enrollment is certainly higher than it's been in recent years. Okay, and we just wanted to confirm that these plan terminations were in fact the driver of the Medicare growth. And so we put together these scatter plots that you're looking at here. Each dot on the screen represents a county in the United States. This is all the counties in the United States. And on the y-axis, we have the traditional Medicare year-over-year growth. And on the x-axis, we have the prior year enrollment in terminated plans. So these are your terminated enrollees. And what immediately just jumped out at me when I first put this together was just the sheer number of dots above the blue line. It looks to me about 50% at least of the counties in the U.S. showed growth in Medicare, which surprised me. And in fact, when we looked at the numbers, actually, yes, it was about 56% of the counties in the United States, representing roughly 70% of the population, showed Medicare growth in 2025. Some other data on the screen here. We know there was a bunch of terminated plans. We know it affected 2.5 million people. So we thought it'd be interesting to look at some prior years to see if this is in fact anomalous. And it appears to be the case. 2024, 7% of counties, so 56 to 7%, huge difference. And you can just see very few dots above the blue line here, and they're all kind of clustered right around the zero line here in the prior year enrollment numbers. So not a lot of enrollees impacted, not a lot of Medicare growth. If we look at 2023, more of the same, a little bit more, 13% Medicare count, 13% of counties showed Medicare growth, but still very little. 2022, same story. So the 2025 numbers are completely ahistorical, anomalous, not something we've seen in the past. And when we plot a trend line, you can see it with your eyes, but you put the trend line on and it makes it obvious. You can see that there's a clear correlation between terminated plans and traditional Medicare growth. And when we plot these two together, we calculated a correlation coefficient, which is a correlation coefficient of 1 would be like perfectly correlated. Anything closer to 1 or 0 would be no correlation whatsoever. This shows a correlation coefficient of 0.62, which in this context is pretty strong. So the growth in traditional Medicare had largely nothing to do with consumer preferences, people making choices. This was a top-down structural change that happened through decisions made by large companies that impacted these folks and made them make some choices. Okay, some other considerations that could be explaining some of the things we're seeing in the practice and also in the data here is that this is something that's not necessarily related to the enrollment data, but we've seen this for the last really couple years, but certainly in 2025, we've seen major health systems in various markets all over the country dropping out of Medicare Advantage contracts. So the most affected insurers are Humana, United Healthcare, Anthem, and Cigna. I mean, those are largely the biggest ones out there, so no surprise there. But when they ask why, what are the reasons given for this? It's generally delayed and denied reimbursements. This concept of pre-auth fatigue, which is a cost control measure. And it adds a lot of strain to the administrative process for the healthcare providers and the patients alike. So I think that's something to pay attention to, especially as these plans and these carriers deal with profitability issues. Nobody, the providers and the patients, from their perspective at least, the pre-auths are not generally viewed as a good thing. And just some unfavorable reimbursement terms and high costs in rural environments. So we don't exactly know what sort of an impact this might be having on patients in the hearing care context, but it's reasonable to infer that if there were referrals coming from patients that were in these plans, that are in these health systems into private practice, the clinics, that this could certainly be responsible for some of the disruption we're seeing, both in third party and perhaps even some of the new patient sales data. And another consideration here is the potential changes in benefits. So Chelsea alluded to this a little bit earlier, and this is some data from the Henry Kaiser Foundation. So we can see here that they list hearing exams and or hearing aids. Let's assume, for the sake of argument, that we're talking about plans with hearing aid benefits. And you can see that as of 2025, 97% of these plans have hearing aid benefits. That's down slightly from 98% in 2024, but it's still a very, very high number. So are these Medicare Advantage plans dropping hearing aid benefits? No, it does not appear so. Are they changing their benefits, though, making them less rich, a little bit less persuasive to the patient? Potentially. We're hearing anecdotes about that. That's much harder to analyze in any sort of a macro sense, just because of the structure of plans being different and how do you determine, copays versus funded benefits and things like that. But we are hearing anecdotes from practices across the country that the benefits associated with managed care plans are, in fact, a little bit less rich, slightly easier to compete with, which could be a strategy that is being taken by some of these companies and these plans as a cost savings measure. And this is just an interesting quote along those lines from the former president of CVS. He said, the industry broadly is going to be trimming benefits and in some cases significantly. That's interesting. Whether that will impact hearing aids, who knows? And of course, exiting from certain counties that aren't profitable. We are seeing that for sure. And we might be seeing something along with benefits. It is impacting other areas of Medicare Advantage plans with like over-the-counter benefits and meals and things like that. But so far, other than the anecdotes, it looks like the hearing aid coverage is largely still there. Okay, so to summarize this section, an ahistorical event occurred, totally unprecedented. 2.5 million lives were terminated from plans. And these primarily came from PPOs, for what it's worth, which are generally a little bit more expensive to administer from the Medicare Advantage company's perspective. At the county level, we can see a strong correlation between these plan terminations and the growth in traditional Medicare. So this suggests a structural top-down cause. It's just driven entirely by plan availability rather than some sort of consumer preference shift. As of April, many of these termed enrollees have re-enrolled in Medicare Advantage plans, yet the traditional Medicare enrollment remains elevated. And I will mention that the third-party hearing aid sales remain depressed. So if they're back, they're certainly not, that we're not seeing it yet in any sort of the sales data or even the new patient data. So given these disruptions in the plans in 2025, what do we expect going forward? The early Q1 earnings show that maybe it's a good idea. Potentially, it's something that will continue if it's producing positive financial results. So yeah, what will 2026 look like, and how will the design of the plans and the availability of the plans shape the enrollment data going forward? Something we'll definitely pay close attention to. Okay, so we're going to move on to the third section here, which is the impact that TPAs have had on private practices. And yeah, so we've talked a lot about the sales results, the enrollment data, how that might be impacting it. But we want to take a quick step back and just kind of look at what this shift in TPA, what the growth in this particular segment has looked like in recent years, what sort of impacts it's had, and if there's a change in the trends and the data, what we can expect going forward as things shift. So we're going to go back to the MVP data set here for this section and take a look at some data here. So what we can see here is steady growth in third-party units over time. No surprise here. Massive growth rates. You can see the bars just getting higher and higher. The percentage growth rates, for what it's worth, have been decreasing slightly. And we've seen, massive growth in those early years, although we were coming from a very low level. As the volume has grown, the growth rates have dropped a little bit, as you might expect. And with 2025 being we're down about 16% year over year. So total reversal of that trend. And just to put into context with the private pay business, we can look at the same data for private pay units only. And we can see that with the exception of 2020, we've seen very solid growth rates there as well. And again, with the exception of 2025, the growth rates of third party have far outpaced that of the private pay business over this period of time. If we look at fitting fees, this is another thing that we paid attention to over the years. How are those changing as TPAs have grown and taken more and more of a percentage of the overall unit volume within private practices? And what we've seen is a pretty clear downward trend every year for the most part on this screen here, especially in the last several, has shown a decrease in the average fee per unit dispensed. So that's not a great trend if that's something that your business, your practice is overly reliant upon. Because it's almost entirely out of your control, if you think about it. And down below, we can just we break it down the major companies involved here. We can see that UHC has really taken the lead, going back to 2022, and really kept that lead, as all of the others have kind of actually diminished a bit. So it's really UHC and everybody else at this point. And I will say that the trend in fitting fees that we're looking at the top of the screen, we don't see that actually with UHC. That's been more or less flat. So the decline in fitting fees is largely, driven by the other non-UHC third parties out there. So just an interesting anecdote there. Okay, so this is what we're looking at on the screen here is basically a thought experiment, if you will, something we put together a couple years ago for a presentation where we wanted to kind of break down the difference between private pay and third party at the patient level to understand what the relative difference is between the two, or in this case, what the TPA multiple is, the number of TPA patients you would need to generate the margin from one private pay patient. And we've looked at this a bunch of different ways. And we've always come, any way you do it, whether it's theoretical or actual, look at actual data, it's roughly 3 is the number, 3 third-party patients for every 1 private pay. And this just kind of breaks it down using some assumptions. The data points are in here, the ASP, less cost of goods, and the binaural rates, average TPA fitting fees. Those are from a couple years ago, by the way. These are all data points that we were able to extract from MVP. So logical, it's a sound logical exercise here, but it's really just kind of back of the napkin math. So what we wanted to do was actually use the MVP data set to identify groups of patients in the third party and the private pay channel and evaluate the actual results of actual patients, not this theoretical scenario on the screen here. So we put together this cohort study where we identified about 250,000 private pay patients and 60,000 third-party patients who had purchases between 2018 and 2021. We picked those dates because we wanted to follow each patient for the subsequent 3 years post-fitting. So that period of time gives us, for even those that purchased at the end of 2021, a full 3-year look at the results. And some of these are fairly obvious, but the revenue per hour significantly higher on the private pay versus third party. The revenue per patient is even more pronounced, the difference, with a 75% less on the third party versus private pay. That makes sense because as we get into the some of these other metrics, you'll see that the private pay patients spend more time in the office, therefore dragging the revenue per hour down, but not so much the revenue per patient. So, but what I was pleased to see when we studied this was that the numbers we put together on the other slide more or less reflect reality. If we look at the margin per patient in this cohort, in each cohort, it works out to right around that 3 times multiple that we were expecting. So interesting to see that. but that's more or less obvious when you think about it. There's nothing that mind blowing about those numbers by any means. However, when you look at the hours per patient and the hours after 1 year post fitting per patient, which are the final two metrics on this screen here, you can see that the TPA patients are spending 35% less time overall in the clinic as compared to the private pay patients. And if we look after that first year where service is generally included, the patients are spending an even smaller amount of time. When we know, though, that's when hearing aids really start to need care and service, and they, wear and tear. That's when they're more likely to need the care and expertise of a private practice, and they're getting a little bit less. So that's just an interesting observation. It's easy to make the argument about the financial differences between TPA and private pay, but I think looking at it this way suggests that the private pay patients are likely experiencing better outcomes, hearing better, more likely to refer their friends, be more satisfied, and so on, just based on the fact that they're spending more time in the clinic. Okay. So a
Make
couple
it quick,
other,
Will.
what's that?
Make it quick.
Okay. All right. All right. I'll make this part early. Okay, cool. So this is a brand new thing we're looking at in the, not brand new, but relatively new thing we're paying attention to in the data set, especially interesting given what we're seeing out there. But we're looking at TPA attrition, TPA reversion, and then this attrition ratio, which is basically pretty simple. TPA attrition, patients who went from private pay to third party. The other way around is patients whose previous sale was TPA and went to private pay. So, and then the difference between, or the division between the two, is this TPA attrition ratio. So when we look at that over time, we can see that going back to 2019, it was essentially 2-to-1, meaning for every one patient you flip from TPA to private pay, 2 went the other direction. As we can see on this chart here, the trend is clearly moving the other direction, with now in 2025, essentially 1-for-1, meaning that patients are going in either direction at the same rate, which suggests a number of different things. But I think it's clearly, the fact that the TPA units are as soft as they are and the private pay business is holding its own. I don't think we're being, the private paid segment of patients within anyone's given database is not being there's not as much attrition happening as there has been in years past. So that's the interesting takeaway there. Okay. For the sake of time, why don't we just skip the summary? You guys can read my final points there on that, and then we can screenshot it if you want, and we can move on.
Okay, great. Sounds good. We are recording this, by the way, too, for anybody who wasn't able to grab that and who'd like to take a look at it later. So not to worry. Okay, let me see here. I want to make sure you guys can see this. Okay, slides are good. Okay, I am going to talk really fast because Will took some of my time, but good news, that's like one of my very few strong suits. So here we go. Okay, so this final section is going to be kind of our outlook for private practice going forward. Of course, like we've shared a ton of data today, but what does this mean for you? I think we've laid out the argument in a number of different ways that a historical change is afoot. Much of what we've talked about in the last hour has been focused on what's happening with Medicare Advantage and TPAs. But the reality is, what happens with Medicare Advantage and TPAs is very much outside of your control. I mean, all you can really decide is to participate or not participate in those plans. You don't have any say over who enrolls in what plan, what benefits they offer, et cetera. So what I want to do next is turn to the elements of your business that are within your control. So specifically, what else can we look at within the MVP data set to understand what's happening and what practices can do to set themselves up for success in the future? So to do that, we're going to look at a few different things here. First, we're going to kind of dive into some deeper level KPIs. So in the very first section, Will showed, some of the highest level things that we're looking at: revenue, units, private pay, TPA, new patient, existing. But obviously using MVP, we're able to go well beyond that as well. So what I have up on the slide here is a chart that's going to allow us to see if there are any differences between this year and last year in some of these KPIs that, again, are within your control and that actually have a big impact on your performance. And what you'll see at a glance, and again, I'm not going to leave this slide up forever in the interest of time, is that pretty much all of these KPIs are doing better this year than they were last year. I mean, increases in ASP overall and in premium and advanced, like those are great for private practices. This average TPA fee is down, which we just talked about. Refund and return rates are down. Upgrade intervals down a little bit, which that's actually a good thing, by the way. That means you're upgrading your existing patients faster. Premium and advanced as a tech segment are up, so fitting patients with higher end technology. And even conversion rate is up a little bit, which I think is very interesting because I know a lot of the theories around softness in the business often come back to consumer sentiment. And not to say that isn't playing a role, especially in what we're seeing with new patients, but it does appear from the data that if a patient's in your office for an opportunity appointment type, they're converting at least as good a clip as they were last year, if not slightly better. So these are KPIs from the entirety of the MVP data set, which are great. However, what matters to you as an individual practice owner or manager is, of course, how your practice is performing. So I wanted to just pop up the screen here with the KPI Center and MVP. We're on the effectiveness tab, although there are many other tabs and lots of other KPIs that exist in here across 6 different categories available at the company, clinic, and provider level across any different time period to help you understand your individual practice, provider, clinic, strengths, and weaknesses. So, even if we know that conversion rate is flat or maybe slightly improving across the data set as a whole, what really matters for you is what's happening to your conversion rate. And it probably depends on which provider you're looking at. So I think, MVP is the tool that's going to help you answer that for your particular business and understand what action you may need to take kind of without lifting a finger. Another thing that we wanted to look at, especially because new patients are soft, is if there are visible changes in how patients are finding their way into our clinics. As you guys probably could guess, doing any kind of analysis for referral sources across 1,100 clinics with different data entry strategies can be challenging, but we have been able to group 70% of all referral sources in MVP into 9 major categories, the top 6 of which we're looking at on the screen here. The other 3 are so small, they're not even really worth taking a look at. Couple interesting things here. So not surprisingly, the insurance managed care referral source is seeing the most decline relative to prior year. And I think important to note, this is like the one major referral source on this screen that you kind of have zero control over. So another thing that, again, probably won't surprise many people is kind of the slow decline of direct mail and newspaper. But what I think is really encouraging is to see that, often the most impactful, organic, renewable, and cost-effective sources of hearing aid sales, which are physician referral, online, and patient referral or word of mouth, are all steady or increasing. Next on the screen, what we're looking at are new patient appointments by day by referral source of the ones that we can identify. So of course, 30% are unknown. You'll see a couple things here that I think align with the other data that we've reviewed today. Insurance managed care, way down. We know that. And while still a large share of kind of the overall new patient referrals, physician referrals are actually down a bit year over year, which that doesn't surprise me either because I think insurance, medical referrals, that could all be related to some degree. Good news, patient referrals kind of holding its own, and online is way up, which I think is great news. That is a referral source that's generally speaking very much in your control to affect. Once again, understanding the current marketing effectiveness industry-wide is very interesting and good to know. But once again, what matters is what's happening in your own practice. So MVP allows you to see on a daily basis which referral sources are delivering and which are underperforming so you can adjust in real time. Given the slow start to this year, I think that's as critical as it's ever been. The final thing in my last 2 minutes here that I think is really important for private practices, kind of now more than ever, is to understand this concept of pipeline, which is actually brand new to MVP. So for my existing MVP users, this will be live in your MVP next week. Can't wait to roll it out to you guys. And so for everyone's benefit, I'm going to start with a couple definitions here for how we define pipeline. So we have this concept of open opportunities, which are the number of unconverted as of yet opportunities that have a future appointment scheduled. So somebody you've seen and is coming back for a fitting or something like that. Future opportunities are what they sound like, opportunities that haven't taken place yet. And pipeline is the combination of open and future opportunities. And I'm going to just very quickly talk about this functionality in MVP. So I'm going to kind of do the opposite of what I did before. I'm starting with an individual clinic look, and in a minute, I'm going to show you the data set. So within any individual clinic, we're able to calculate your current pipeline, as well as give you some additional context around how your numbers are performing relative to historical benchmarks with the concept of a baseline. So we can look over your preceding 12 months and also what you had 30 days ago to give you kind of a long view and a much more recent reference point. And what you can see here, purple line is the pipeline, which is a patient count, and the green area chart behind it are unit sales. And what you can generally see with any clinic, including this dummy clinic here, is that pipeline will surge, and sometime shortly thereafter, the unit sales will follow. Same thing is true as pipeline dips. You'll see that the unit sales eventually dip as well. How long it takes for those surges and dips will depend on your business model and how you fit hearing aids, whether it's same day or you bring people back or whatever. But the pipeline is very indicative. It's a little glimpse into the future of what's happening. We can also project the number of units you're going to sell in any time period based on your pipeline, binaural rate, conversion rate, things like that. Where this gets really interesting, in addition to your own numbers, is when we zoom out and look at the entire data set, which is what we're looking at right now. And one thing I want to note, and this is like a knock on us, if we had had this feature built at the end of last year, we would have been able to sound the alarms on the softness likely coming in the market much sooner than we did in February. You can see here the pipeline was dipping exceedingly low at the end of the year, start of this year. And sure enough, units were really high. Everybody was riding high, feeling very confident coming into 2025, but we could have seen that trouble was afoot. And one thing I want to note here is while there has, certainly been a bounce back in pipeline over the last couple months, we're dipping down again. So I don't think by any means we are out of the woods. And a lot of these concepts we've been talking about today stay very important. So, you can't control what's happening with Medicare Advantage. All of those major things will covered, but you can control the KPIs in your practice that drive performance. Certain referral sources are very much in your control and are doing really well this year. So having strong strategies to build and grow those referral sources, I think, is essential. And finally, just this concept of pipeline can help predict future performance. Real-time visibility into the strength of your schedule can help you adapt quickly and not miss out on opportunities. So we are going to get to Q&A. I'm going to have Kate share slides now. And I just, I want to say that I know some of the messaging today has been sort of positive and some has been maybe somewhat negative, but regardless of what's going on in the macro economy or in the insurance marketplace or consumer sentiment, I really believe the most important thing you can do is to understand the health of your business in real time. And the only way to do that in hearing care is with MVP. It's going to take the enormous amount of data that you generate, bring in external data sources, enrich, transform it, and deliver you with insights that are going to help you understand where your unique opportunities are in your business. I would encourage anyone who's not a current user of MVP to scan the QR code or go to our website, schedule a demo. We'll send you an MVP Yeti mug or buy you coffee or both. And I know we're over time. So with that, we'll leave that up on the screen and I'm happy to go to the Q&A. So we have a few questions already that we'll go through. And if anybody has questions that hasn't asked them yet, feel free to go ahead and do that now. Okay, one question here is whether TPA includes Medi-Cal. Will, do you want to take that one?
No, largely no. It's possible that some could sneak in depending on the way people invoice them, but no, those are generally those would be in the private pay bucket. I know that's not the exact correct definition, but they're usually included in that segment.
Okay, great. Someone's asking the definition of pipeline. I know I had to go through that so fast, so I apologize. But just to clarify, pipeline is defined as the sum of your open and future opportunities. We define in MVP an open opportunity as one that has begun and not yet converted and has future related schedule activity. So if somebody comes in for an initial HAE and they take home a demo, or you've ordered hearing aids and they're going to come back and be fit next week, we would not want to call that a missed opportunity, which is yet another KPI or metric in MVP, because there's still open schedule activity. We would not count like a 6-month clean and check as a schedule activity related to an opportunity, because that's not so much. So we give kind of like a 90-day window of related appointments to determine whether somebody's opportunity is still open or not. And then, so that's half the definition, open opportunities. Future opportunities are ones that are scheduled out in the future, but have not yet begun. And one thing that we do in MVP is set up custom opportunity logic for every practice who wants it. So we can customize which patients are considered opportunities based on a combination of things such as appointment types, hearing loss level, age of hearing aids, age of patient in the absence of hearing loss, or other factors as well. So hopefully that answers that question. Okay, there's so many questions here. Let me try to get through these really quick. Somebody's asking to see the new patient drop percentage again, and they're asking to take a picture. We're going to send out a recording to everyone who attended today. So hopefully that will work for you, and everybody will be able to take a look at it. Somebody's asking if we're independent or manufacturer owned or supported. And I am thrilled to say that we are an independent family owned company, me and my two brothers, nobody behind us, just doing this out of love for the industry. So, yeah. Um, okay. Here's a question. I don't know that we know the answer to this. Do we know if the big box stores are seeing dips in new patients, Will?
We don't know that. I did stop at every time I go to Costco, I stop and say hi to the guys there. And I did ask them, and the one Costco hearing aid dispenser I talked to said they were a little bit slow this year, which is unusual because I know they're always really busy. But that was anecdote and of one, so I wouldn't read too much into it.
Yep. Okay, great. There's two questions here that are kind of related, so I'm going to combine them. So somebody's saying, based on my understanding of the MVP data set, TPA trends might be more indicative of provider behavior rather than patient behavior, which I think is a fair question. And someone else is asking, is it that practices are leaving TPA programs? Could that be part of the attrition rate? Do you want to tackle those first, Will?
Yeah, I think that is absolutely happening, and we know it is in just in conversations. Teasing that out of the data is might be tricky, but yes, it's reasonable to assume that's having some impact on the decline in third party. Although those plans, those strategies have been implemented now for several years, so in theory, the year over year trends would reflect that people doing the same stuff in the prior periods. So, but yes, it's a reasonable
And I'll
point.
just add that, again, I don't have access to any data on this, but I have chatted with a number of friends in the industry who have knowledge of the various channels within the marketplace and asked them just kind of high level how things are going. And what I'm hearing is that TPAs are soft everywhere because, again, the data that we pull from the MVP data set is limited to the participating practices, which are generally speaking independent private practices. And so we know that's a limitation of the data. Um, but again, in just kind of chatting with people in the know, it sounds like some of the other channels by which TPA units are dispensed, you can kind of imagine what those are soft so far this year as well. So,
Which I think
yeah.
points to the fact that whatever anomalous activity, ahistorical data shown in the most recent enrollment periods would be a more likely explanation of the continued softness in third party, given that that would affect all channels of the hearing care space.
Okay, well, here's a question on any data or thoughts on if the OTC market has increased in this time where we're seeing new patients be down in private practices.
Not that I'm aware of. And I think the trickiest thing there would be that a lot of people have pointed to the Apple AirPod hearing aid functionality as being potentially behind some of this. And I don't know if that's true or not. I don't have a strong opinion one way or another. However, I know that it would be almost impossible, unless maybe you worked at Apple and had visibility to the number of people enabling that feature, to know how many people are actually using that. And if that's eating into what would have otherwise been independent, hearing care, private practice sales, I don't know. And I think a lot of the OTCs are, sold on sites like Amazon and things like that, where they're not going to be reported in any industry numbers. So I don't know. My gut tells me it's not having a huge impact, but that's literally just my gut feeling.
Okay, great. This question is, what CRMs do we work with? And the answer is we work with Counselor, Cycle, Blueprint, Suno, Tim's, and AudioClick. And if you work with a system outside of one of those, please reach out to us. We're always happy to consider new integrations. Um, okay, someone's asking if there's a way to see data for traditional Medicare plus a supplement. Do you know that?
To the best of my knowledge, and I've looked far and wide, that data does not exist. I think the reason being that Medicare Advantage is publicly funded, therefore, like the public has an interest in seeing that data. Where Medicare, we can see original Medicare enrollment, but Medicare supplements are not taxpayer funded, therefore not publicly available. The data on that, I wish it was.
Yeah. Someone's asking about correlating data from investment in marketing initiatives to marketing effectiveness to understand whether some of those changes are related to changes in spend. I mean, we don't have good access to that data in any kind of scalable way. So, Yeah.
No, but that would be an interesting study to put together if we could identify a group of practices. But yeah, that would be very interesting.
Another comment here is just I think the question is if you could take that TPA cohort study out 5 years instead of just 3 years, because this person's observation has been that TPA patients replace their devices sooner, but private pay patients keep them longer. And that could potentially adjust the math there.
Yeah, that is, yeah, absolutely. A lot of those plans have they renew the benefits renew sometimes as early as 12 months. But yeah, it's like a 36-month like benefit renewal could certainly change the buying behavior and upgrades. So yeah, we could certainly do that, and maybe that would be slightly more favorable to the third party cohort potentially.
That math's going to change in general though, because like the fees are lower now. And so we should, yeah,
Yeah,
it could be reworked in a few different ways. So,
sure. Yeah.
um, here's just a comment from someone who says this is their first year of opting out of all managed care, and this person's noticing a real increase in their private pay ASP, which they think is due to not having to compete internally with TPAs, which was dragging overall ASP down. Which I
Yeah,
think
there is a
makes sense. Yeah.
simplicity and to a complete opt out that allows you to be much more bold and firm with your pricing. There's a lot of benefits to doing it. So yeah.
Okay, one more question I have here. So we'll make this the last one unless anyone drops another one in. But this person's asking why existing patient purchases are up so high, and whether we know if it's due to increased industry marketing to existing patients, like technology and product launches. Do you have any thoughts on that?
Yeah. I don't have a firm answer on that. But I do think yeah, there's been some product launches for sure that have been quite successful. Um, I think that's segment of the business is actually, especially at the macro level, the market level, it's more consistent. Um, it's less prone to big swings. So yeah, maybe just an inertia thing of all the people who bought hearing aids in the last 5 to 10
And a
years.
necessity.
Yeah,
I mean, if
yeah.
your new patient business is way off, you're probably spending more time, money, energy, right, generating existing patient opportunities, I would think.
Absolutely. And the practices we've worked with have absolutely, in the face of the slowness on the new patient stuff, have kind of redoubled their efforts on their existing patients. So I think it would be, yeah, just basic human incentives would suggest that people are focusing more on it because you have to right now, or if you want to grow, it's where the growth opportunity is for most practices.
Yeah. Okay, great. That's all the questions I have right now. So I want to thank everybody so much for being here. We really appreciate it. And have a great rest of your day. We'll get the recording out soon and let us know if you have any questions or ideas for things you'd like us to take a look at. We always love to hear from you guys. So thanks so much and have a great day.